Evolution of Philippine taxation. Taxation during the Commonwealth period. Income tax rates in 1936. New measure and legislation were introduced to make the taxation more equitable. Income tax rates were increased, adding a surtax rate on individual net incomes in excess of 10,000 pesos. Cedula tax, 1937. Cedula tax was abolished, which appeared to be a progressive move. Citizen aged 18 years old, 1940. A residence tax was imposed on every citizen aged 18 years old and on every corporation. Commonwealth government drafted the National Internal Revenue Code, introducing major changes in the new tax system, 1939. 3% normal tax and surtax on income was replaced by single tax at a progressive rate. Personal exemptions were reduced. Corporation income tax was slightly increased by introducing taxes on inherited estates or gifts donated in the name of dead persons. Cumulative sales tax was replaced by a single turnover tax of 10% on luxuries. Increase in taxes of liquors, cigarettes, forestry products, and mining. Dividends were made taxable. The Japanese military administration in the Philippines during World War II. The Japanese military administration immediately continued the system of tax collection introduced during the Commonwealth, but exempted the articles belonging to the Japanese armed forces. Foreign trade fell and the main sources of taxation came from amusements, manufactures, professions, and business licenses. The expenditure of the Japanese military government grew greatly, and they issued military notes in order to cover the cost of the war. Fiscal policy from 1946 to present. United States advised the adoption of direct taxation, Philippine President Manuel Roxas. The impact of Philippine economy was effectively disparate, as Manila, the capital, was razed to the ground while the rest of the Philippines was relatively untouched. But the highly agriculture-based economy was disrupted. Economic situation was problematic by 1949. Severe lack of funds in military and education sectors. United States advised the adaptation of direct taxation, but Roxas declined this proposal. A direct tax is a tax that a person or organization pays directly to the entity that imposed it. An individual taxpayer, for example, pays direct taxes to the government for various purposes, including income tax, real property tax, personal property tax, or taxes on assets. Import and exchange controls, Philippine President Elpidio Quirino. Impetus for economic growth through the implementation of import and exchange control that led to import substitution development. This policy allowed for the expansion of a viable manufacturing sector that reduced economic dependence on imports. New tax measures will also passed, which included higher corporate tax rates that increased government revenues. 1948 to 1953 twofold increase in tax revenue. Philippine President Magsaysay, President Garcia and President Macapagal. Tax Commission in 1959, RA 2211. To make way for a more robust and efficient tax collection scheme. The period of post-war republic also saw a rise in corruption. Congress did not pass any tax legislation, 1959 to 1968. Omnibus Tax Law of 1969 did not increase the ratio of income tax to general revenue. Collection of taxes remained poor. Tax structure was still problematic, and much of funds were lost to corruption. 70% of total tax collection from indirect taxes, Philippine President Marcos 1981-1985. Tax system remained regressive. A regressive tax is a tax applied uniformly, taking a larger percentage of income from low-income earners than from high-income earners. During the latter part, 1981 to 1985, tax system was still heavily dependent on indirect taxes. Indirect taxes are those taxes that can be shifted from one individual to another. It is not levied directly on the income of the taxpayer, but is levied on the expenses incurred by them. Taxes grew at an average annual rate of 15%, low tax yield. Tax effort, 10.7% tax effort is defined as an index of the ratio between the share of the actual tax collection in gross domestic product and taxable capacity. 1986 Tax Reform Program, Philippine President Corazon Aquino. Reform Tax Program, 1986, to improve the responsiveness of the tax system, promote equity, promote growth, and improve tax administration. Major reform in the tax system, value-added tax, VAT, 1986 with the following features. 1. Uniform rate of 10% on sale of domestic and imported goods, services. 0% on exports and foreign currency-dominated sales. 2. 10% in lieu of varied rates. 3. 2% tax on entities, less than 5.2 m annual sales. 4. Adaptation of tax credit method. 5. Exemption of the sale of basic commodities. 6. Additional 20% tax on non-essential articles. Administrative reforms. Restructuring of the Department of Finance, BIR. EO 127. Tax collection and tax audits were intensified, computerization was introduced. Tax and revenue effort increase, 10.7% in 1985, to 15.4% in 1992. 1992 Political stability, Philippine President Fidel Ramos ventured into its own tax reform program, 1997. Comprehensive Tax Reform Program, 1997, RA 7716. 1. To make the tax system broad-based, simple, and with reasonable tax rates. 2. Minimize tax avoidance allowed by existing flaws and loopholes in the system. 3. Encourage payments by increasing tax exemptions levels, lowering the highest tax rates, and simplify procedure. 4. Rationalize the grant of tax incentives. VAT base was also broadened in 1997, RA 7716. 1. Restored the VAT exemptions for all cooperatives. 2. Simple process. 3. Original state. 4. Exemption of tax in some commodities. President Joseph Estrada, 1998. Too short to constitute any change in the tax system. Philippine President Gloria Macapagal Arroyo. Increase government spending without adjusting tax collections. Large deficits from 2002 to 2004. The government had to look for additional sources of revenue, RA 9337. Known as the Expanded Value-Added Tax, EVAT, 2005. The Expanded Value-Added Tax, EVAT, is a form of sales tax that is imposed on the sale of goods and services and on the import of goods into the Philippines. It is a consumption tax, those who consume more are taxed more, and an indirect tax, which can be passed on to the buyer. VAT tax rate from 10% to 12%, February 2006. Philippine President Benigno Aquino III, 2010. Promised that no new taxes would be imposed and additional revenue would have to come from adjusting existing taxes. Venture into adjustment of sin tax reform, RA 10351. A sin tax is an excise tax placed on certain goods at time of purchase. The items subject to this tax are perceived to be either morally suspect, harmful, or costly to society. Examples of sin taxes include those on cigarettes, alcohol, gambling, and even sugary drinks. DOH budget, triple in 2015. Full health, 55.2 M in 2012, to 515.4 M in 2015. Philippine President Rodrigo Roa Duterte promised tax reform. Lower income tax rates of working Filipino. Limit VAT exemptions. Increase excise taxes.